Hi, welcome to today's intermediate accounting lesson. So in this lesson, very early in our course, we're reviewing some of the things that we were learned originally in Accounting 211 and Accounting 212. One of those things we learned is the basic accounting equation. And here we have assets on the left is identical. Notice the 3 bars that I have there. If that symbol were 2 bars, it would be equal. But I'm saying assets are identical to liabilities and owner's equity. So the point I'm making here is that we have assets on the left, and then we have assets again on the right, except on the right, we're regrouping the assets by, does the creditor or the owner have first right to the assets? So if the creditor has first rights to the assets, we're calling them liabilities. And if the owner has first rights to the assets, these are owner's equity. So since we're looking at the assets on both sides, they have to be identical. I sometimes distinguish that if I have a $100 bill in my pocket and you have $100 in the bank, we have things that are equal, but we don't have things that are identical. Identical means the same. Exact same. So, quick review on journal entries. We can have normal journal entries and we can have adjusted journal entries. So, any particular transaction that we have, and your chapter talks a lot about these, and so does your homework, we'll debit an account and we'll credit an account. And we could have a compound entry where we have more than one debit or more than one credit. But the big thing is there has to be some debits and some credits, and the dollar amount of the total amount of the debit and the total amount of the credit have to be the same. Well, we also have adjusting journal entries, and these aren't just normal transactions in the normal course of business. So to describe a normal journal entry, I might think of something as simple as accounts receivable. So if we sold $10,000 worth of consulting service, we would debit accounts receivable and we credit sales immediately, just because we had an invoice. Adjusting journal entries work differently. These are where normally there won't be any invoice, but at the end of a period, we're going to have to adjust assets or liabilities because they've changed. And so some of these that you've seen in previous classes are supplies change. You know, we don't have as many as we did when we first bought them at the end of the month. Equipment is used up, and so we take depreciation expense against it. Sometimes if we prepaid a subscription, we've used up some of the subscription and so on, so we do adjusting journal entries. Well, let's remember what the 4 basic financial statements are. We have an income statement, we have a balance sheet, a statement of cash flow, and a statement of stockholders' equity. These are the basic four financial statements. Let's review the closing process. So in the closing process, what we're trying to do is close revenue, expense, and dividends into the owner's equity account. So here we're reminding you that the first entry in the closing process is to debit all the revenue accounts. A lot of times that's only one, but if there's more than one, they all have to be debited, and credit income summary. Now remember here, typically during the year, revenues have credit balances. So by debiting them here, we're turning them to 0. The second closing entry is to debit income summary and to credit all the expense accounts. So what I've written here in the middle of this page is way oversimplified. Ordinarily, the second entry will have 1 debit income summary and maybe 30 or 40 credits, all the expense accounts. Now during the year, the expense accounts have debit balances, so this journal entry is going to have the effect of crediting and turning them to 0. So the third entry is kind of a net entry. If this were a more detailed video, I might show you this on T accounts or something, but here we now have a balance and income summary. If you look back at 1 and 2, number 1 credits an amount into income summary. Number 2 debits an amount into income summary. And if you really think about what it is that is being debited and credited there, it's net income for the year. So in the third entry, if we have net income, we're debiting income summary and crediting retained earnings. But if we had a net loss, we would be debiting retained earnings or reducing it and crediting the income summary. And I've written out to the side of journal entry 3 here that this is to zero out the income summary account. The fourth closing entry is to debit retained earnings and credit any dividends, because during the year we might have debited dividends and paid cash to the shareholders. Here at the end of the year, we're just going to go ahead and close the account out. At the end of the period, we have closed revenue and expense to retained earnings, also closed dividends into owner's equity, and then we pay dividends out of the retained earnings. Last thing we want to talk for just a minute about is how you would make changes to a cash basis financial statement to make it accrual. Remember, we need to do accrual basis financial statements in intermediate accounting. It's the only official method of accounting, the only method supported by standards. So if we are looking at a cash basis net income, we have to add any increases in asset accounts, like, for example, accounts receivable or inventory. We don't, by the way, add the increase in cash. We'll decrease or subtract decreases in assets. We'll add decreases in liabilities, such as accounts payable, and we'll subtract increases in liabilities, such as accounts payable. And when we're done, we'll have converted cash basis to accrual basis. Take care. Let me know if you have any questions on the material.